Hi guys, welcome back to the YouTube channel. So as we approach a new tax year, the 2025-2026 tax year, what is the most tax efficient way that you should be paying yourself from your limited company as a director? Well, the good news is we've got a fantastic information packed slideshow that we're going to run through to cover absolutely everything you need to know about limited companies, the taxes, and how to pay yourself from your own limited company. Stick around to the end to make sure you don't miss anything when it comes to paying less tax in your limited company. To the slides. So, how to pay yourself from a limited company in the new tax year, the 2025-26 tax year. First place to start really is just by recapping the income tax bands. These haven't changed much for the past couple of years, and they won't be changing until 2028 unless Rachel from accounts changes her mind. But as you can see, we've got the personal allowance. That's still 12,570, giving you a tax-free allowance there. We've got the basic rate band of 37,700, and usually it's that figure of those two, the 12,570 plus the 37,700, that you see thrown about as the higher rate band, effectively the basic rate band before you become a higher rate taxpayer of £50,270, which in my view is the most tax efficient amount of money to take from your limited company. Because if not, as you can see, the tax bands jump quite significantly. As you become a high rate taxpayer, it goes from 20% to 40% on earned income, and for dividends goes from 8.75% up to a whopping 33.75%. So if you can, and you strictly want to save tax, it makes sense to plan your income around those thresholds. So let's recap some of the income tax allowances that we've got. So as you just mentioned, we've got the £12,570 personal allowance. As a note on that, if your income is over £125,140, you actually lose your personal allowance. So that personal allowance is withdrawn by £1 for every £2 of income over £100,000. At 125,140, that personal allowance is fully lost, which for a lot of people actually creates an effective 60% tax band. The only way to potentially plan around this is to make pension contributions, bring your adjusted income below the £100,000 again, so that actually your personal allowance becomes available again. Then we've got the £500 dividend allowance, so you can receive this much in dividends completely tax-free. £1,000 for basic rate taxpayers, and then £500 for higher rate taxpayers of personal savings allowance. This is interest income that you can get tax-free. And then we've got a little known tax relief here, which is your £5,000 savings nil rate band. So if the first £5,000 of your taxable income is interest income, which don't worry, we're going to run for an example of this in a minute. Well, actually, that interest income can again be completely tax-free, saving you tax at 20%, so £1,000 of savings there. Just want to pause this video to right here. Are you finding this tax saving content useful? Then please do hit that subscribe button and that like button to help this video impact as many people as possible. Back to the video. National insurance, to be honest, this is where all the changes have taken place. Income tax is all the same still. It's literally just national insurance that's different this year compared to last. So a couple of different things. The first one is the lower earnings limit. That's gone up slightly to 6,500. So you need to earn at least that much as a salary for it to count for a qualifying year for state pension purposes. Then we've got the primary threshold. That's still 12,570. That's your employees' national insurance threshold. Then it goes to 8%, up to 50,270, and 2% above that. You don't need to worry too much about that. The big change is the secondary threshold, which is the tax that a company pays for having an employee. The threshold for this has gone down massively to just £5,000. And actually, the rate that's charged on salaries as well has gone up quite a bit to 15%. And that's charged on the full amount of salary, regardless of whether they're paid £20,000 or £100,000. It's 15% on anything they earn over that £5,000 mark. But most employees with more than one individual on the payroll will qualify for the employment allowance, which covers up to £10,500 of employers' national insurance. So as you'll see, as we run through some examples, but it's usually quite beneficial for you to add somebody else onto the payroll, because if you're the only director on the payroll, you've not got any other employees, well, there's no second directors on the payroll, you won't get that employment allowance, and it'll cost you just over £1,000 a year in employers' national insurance. So actually adding someone else, could be tax efficient, and it can actually help you save employers' national insurance in the company as well. Corporation tax. This is the tax paid by the company on the profits for the year. Revenue less all of your allowable costs. Pension contributions are also a great idea because they reduce profits and the corporation tax. And it's important to note that the salary payment and any employer's national insurance, if you do pay it, you don't qualify for the employment allowance, that is actually fully tax deductible as an expense and well. The rate of corporation tax depends on quite a few different factors, but broadly, it's a number of associated companies. So it's a number of companies that you actually personally control. So if you've got a couple of different property investment companies, this would all bring down your small profits threshold and your marginal relief rate. And actually, you'll be paying a higher rate of tax on a lot more of your profits. So it's 19% on the first 50,000, 26.5% on profits between 50 and 250,000, and then 25% on profits over £250,000. Paying dividends. Dividends are a distribution of profit paid to shareholders, not necessarily directors. A lot of people think, can I have my child as a director so they can take dividends? No, you can't. Shareholders get dividends. Directors just run the company. It's important to note that you must have sufficient reserves, fair value gains. So if you revalue your properties, they're not distributable for dividend purposes. You can't take dividends from that. They're unrealized. And you can take dividends any time during the year as an interim dividend. It's usually best to do this so your director's loan account doesn't build up over the year and it gives you that flexibility. And as we covered before, it's subject to the income tax rates, the 8.75%, the 33.75%. Paying interest. This is a fantastic tax efficient way of getting money out of your limited company. If you've got a loan from you personally to your limited company, you can't do it if it's the other way around. So, of course, if you owe your company money, that's usually a bad place to be in from a tax perspective. But if you've got a property company, that's usually where we see it, where you put money in as a director's loan to fund those property purchases. But actually, your company owes you money, and just like any other normal loan, you could charge interest on it. It's going to be a market value interest rate, but typically for unsecured lending, 10, 15, 20% isn't unreasonable. And this is subject to income tax in the same way as a salary, but there's no national insurance. And of course, you've got the savings nil rate band and your personal savings allowance. Do remember to do a CT61 each year, though. And on this, you've got to declare the amount of interest that's been paid, and you've got to also deduct 20% income tax. The company pays that over to HMRC, and then you get a credit for it on your self assessment. And of course, all of the interest expense that the company incurs is fully tax deductible, saving corporation tax inside the company too. Here's an overview of the most tax efficient salary to be taken where you've not got a director's loan account. So the first thing you want to do is take the full salary of 12,570, which will have no income tax as it falls within the personal allowance. There's no national insurance on a personal level because that meets the threshold, but there will likely be employer's national insurance on the difference between 12,570 and £5,000. That secondary threshold at 15%. But hopefully this is covered by the employer's allowance. But it's worth mentioning that even when the employment allowance isn't available, it's still worth taking the higher salary because in the company, the minimum tax saving is going to be at least 19%, probably higher than that, which is obviously greater than the associated cost of 15% national insurance. So it's still worthwhile taking that higher salary. If you don't want any admin at all and you are the only employee direct on the payroll and you don't want to be paying national insurance each quarter, well, the 5,000 salary is the best to take to keep things simple. But if you want pure tax efficiency, you don't want making those payments, the 12,570 is the best option. Anything over and above this, take as dividends. Total income tax on £50,270 taken as above would be £3,255. And we've got a breakdown of it here. So salary, 12,570, assuming that there's no EA available, employer's allowance, employment allowance, whatever you want to call it, that's going to be £1,135.50. That's a tax deductible expense that the company pays. You'll then take dividends of £37,700. The first 500 tax free, the remaining 37,200 at 8.75%, giving you £3,255 to pay in income tax. Not bad, pretty tax efficient in my view there. But things do get better where you've got a loan. So if you've got a loan to your limited company, you can charge a decent amount of interest on it. This is definitely the best tax efficient way of doing it if you're in that position. So just as before, you'll take the full salary, the 12,570. And it's worth mentioning that it's only worth taking that if the employment allowance is available. If you've got a very large director's loan account, you probably just want to actually take the salary of 6,500, so it counts for pension purposes. because you'll be paying the employer's national insurance if you can't get the employment allowance, and then actually top up the difference in the tax bands here with interest. But assuming that you can, it makes sense to get the 12,570 out as salary, no income tax, hopefully no employer's national insurance because the employment allowance is available. And then you want to take £6,000 of interest out to utilize your savings nil rate band and your personal savings allowance. Those two thresholds we spoke about at the start of the video, the 1,000 and plus the 5,000 bands. And then take dividends up to the rest of the total tax bands up to £50,270. And the total tax charge in this case is only £2,730. So it's quite a significant drop compared to the previous example, and this is due to us utilising that savings nil rate band. Paying your partner, if you're married, you've got a spouse, and they've got no other income, try to get them involved in the business if you can, doing a little bit of work so that you can justify paying them a salary. If they have low or no other income, they can actually bring a huge saving where you take over, you're a higher rate taxpayer, you take over the 50K mark and you're paying tax at higher rates. But actually, as a minimum, you can pay them a salary of 12,570 if they do some work, which will save the company £2,388. If you can potentially look to pay them more, if you can give them dividends, that's a great way of actually extracting more wealth. So if they own a share of the company, either that just with ordinary shares or with alphabet shares, that can actually allow you to pay them dividends, minimum £500 a year tax free. But if they've got a lot more of their basic rate band available, well, actually it makes sense to pay more out. Admin, each month when you submit a PAYE to HMRC, your payroll records, that's going to be done each month, declaring who's been paid what and any taxes deducted. For most companies, the PAYE, pay as you earn taxes, will be paid either monthly or quarterly if you're a small business. Also, remember CT61 if you are charging interest, and budget for the income tax on your dividends. What you're getting isn't all yours. As you've seen, there's probably either about £2,500 to £3,500 worth of tax due to HMRC at the end of the year. And of course, for the first year you're running your business, they want payments on account. So they actually want 50% of next year's expected tax liability paid up front as well. So make sure you've got a decent amount set aside for taxes. And of course, check the specifics with your accountant to confirm that this is 100% right for you. If you do want to find out more about this tax saving information and whether it is right for you, we're helping clients with this all the time inside the Tax Smart Club, where people are asking me questions and I'm looking at their personal circumstances and giving them the best advice, and a lot more practical information on there as well, such as how to actually register for PAYE. We've got that in there, a demonstration of filing a CT61, and so much more, all inside the Tax Smart Club. So if you want to check that out, click that link in the description as to how to sign up. Other than that, that's all for today, guys. See you next week. Bye for now.